Fred, we just went to the Texas Middle Market Multifamily Conference here in Dallas.
Mm-hmm.
We are actually in our Dallas office, in our podcast studio that we have here in the office. We wanted to do a little recap for you all, just kind of tell you what we learned this week, what we maybe already knew, what assumptions maybe you had from the lending perspective that you got confirmed, things like that. So we're gonna do a quick 3 recap topic and just kind of let you guys know how the market's doing and take it from there. So Fred,
Sounds good.
thanks for being here, man.
Well, thanks for having me, and I've got my cold brew coffee here for Coffee Ground. So
got my
to that.
agua today, so
Nice,
we'll go
nice.
with that this afternoon.
Yeah, so top 3 takeaways. Obviously coming in from Arizona, it was a good experience. Got to meet a lot of people. It was a good turnout.
Yeah.
Great venue.
Marriott,
love it there. You can't, downtown Dallas, you can't really beat that. So
Yeah, some good views.
But yeah, we had some plenty of topics to talk about, but I think that would take up quite a bit of time in the podcast spot. But top 3 to go over. I think we were, number 1. I think we were talking about underwriting standards.
Yeah,
and,
definitely. Yep.
And how just hearing different investors, lenders, other capital markets people,
Right.
And how there was a consensus. I think that was probably the number 1 takeaway is how there is a consensus of so many different people in the market, be it if they're on the equity side, lending side, debt side, and how there seems to be that realization of, okay, hey, these 80% leverage deals, these, rent growth 5%, 10% a year are gone. And I think most people were pretty savvy, kind of knew that it's like, hey, we had the heydays, that was great when it lasted, but now it's kind of a little bit more of a realization of like a normalizing. So I think it's good to kind of have that, especially being on the lending side. You know that, but I couldn't tell you how many times we have borrowers come through and we're
overly optimistic, we'll say.
Overly optimistic, and even when you try to tell them, hey, look, this is what deals are penciling out at, this is what lenders are looking at, and having to kind of be that bad person or the bad guy to come in and say, hey, look, this is actually where your NOI is going to be placed at, and having them kind of figure that out. No, I can get this is what it is, until ultimately that's what happens off of either the appraisal or when the underwriter comes back and it's like, no, this is what we can see it. So that was really interesting to learn about, and we can go through a little bit of details on that. So,
no, I think you're exactly right. I think there was a lot of folks that were either on the panel or owner operators or lenders or whoever, right, that we either talked to or heard from, that kind of had that sentiment, right? Like they had been underwriting differently at one point, and now they're underwriting what I would say closer to our SITG's like conservative values, right? We don't project for a lot of rent growth right now. We're really only looking at maybe projecting for slight rent growth, and I'm talking like 2-3% by year 2, 3, et cetera, right? In certain markets, and it is market dependent. We got to remember that when it comes to real estate, right? I think everybody's kind of on that page now, and they understand that. But to your point, they're not going to try to underwrite 5% rent growth right now. Anytime now or in the future, whether or not that's going to happen. Of course, we can't predict if it will happen in the future, but I think that was good to hear. There was a lot of good takes from lenders in general. There was some great lenders up there just talking about how they've gotten more conservative with certain things. I think for us at SITG, we're really focused on reducing expenses, and that's how we're going to increase NOI. We're not so focused on, hey, can we drive rent growth? Can we do this? Can we do that? There was a lot of people that had done value add in the past, and they talked about that and are still doing it to a degree, right? But they're not projecting for the same numbers that they used to be from, we're going to replace countertops and we're going to paint, we're going to do this, and then we're going to get, and another 15% on top of that. They're not necessarily projecting for that anymore, and I tend to agree with that, right? I think there's some room there potentially, but it isn't what it was in its heyday. it's cyclical, of course, so I'm sure it will get back there as supply starts to, dwindle down, as all of these new builds that come to market are going to dwindle down over the next 2 years or so. We'll get back to a place where maybe you can underwrite a little bit more aggressively, but for now, I think that was a takeaway, and it was good to hear that most everybody's kind of on the same page there now.
Absolutely, I agree. And to kind of even expand a little bit more on that, just kind of what some of them even mentioned in terms of what they're looking at. I think that was a huge question that a lot of people wanted to know. Is like, okay, what are you underwriting your rent growth at? What are you underwriting your expenses at? Because a big topic was, of course, what are you doing about inflation and potential tariffs, and how are you adding that risk level into the pro formas, which is I mean, it's a question to be asked. So I mean, and it was tough getting obviously fairly straight answers with that, because it's different. Depends, everyone has a different opinion on how that'll play out. One thing that I absolutely, even on the lending side, agree with what they're doing is rent growth. I mean, you really have to be conservative about it.
You do. I agree.
The first year rent growth, you can't even really bake that in. You just kind of, hey, things are changing. There might be things that come out, so you kind of have to keep that at that zero. And if you're doing that 5-year plan towards the end tail, yes, you can start baking in some rent growth on that. Something that, whenever I'm underwriting a deal on the front end, that even that they were talking about is, and this is something that I constantly have to kind of let even potential borrowers know. It's like, look, I get that, on a cash flow standpoint, if you're looking at, okay, does this deal pan out for your long-term hold and for your investment? Absolutely, that's completely different than what a lender is going to underwrite it at, and their risk tolerance for the model. So there's some keys that in every one of my underwriting assumptions that we include, and that's vacancy. Doesn't matter if it's 100%, if it's been 100%. In most markets, you're going to get hit with an underwriting 5% vacancy. That's just pretty standard. And we get people like, oh, well, it's been 10, 20 years, it's always been 100%. And yes, you can kind of consider that and maybe argue that with the appraiser, but
I think on the smaller deals more so than
absolutely
ones, right? Because the bigger ones, you're never going to really be at 100%. So,
absolutely. And I mean, from the appraisals that we see that come through on the deals, you're seeing some bit of some vacancy there, because they're going to do it on a comparable, and they're going to bake that in. So vacancy, you really have to account for that. Management, it's a big one. People, I get it. You can self-manage. That makes sense. But when you're looking at it as a lender, they have to come with it at a lens that you fail. And that's just how it is.
That's how they have to look at it, right?
Hey, if you can't do it, they're not going to pick their team up and go and move and manage the property. They're going to get a third-party manager, so they're going to have to account for that. And some people don't realize that. And a big point that they even mentioned that was really good was when you're looking at some of these offer memorandums that are provided from the brokers, and you just try to go and you're sorting through deals and you look at just cap rate. It's like what their NOI they're showing. If you look at the T12 and their rent rolls and things like that, a lot of times they're not considering management fees. A lot of times they're not considering, and this was that Freddie Mac lender, or who spent time in the Freddie Mac who mentioned this, replacement reserves.
Sure.
That's a huge one.
Yeah, especially on the older deals. I mean, you have a lot more that you have to account for there. I think,
And a lot of people, we're so used to the standard of it was $250 per door. That was it, $250 a door. Okay, cool. We'll run that through. Now, depending on if the property's 5 or what is it? Is it 25 years or more older or 50 years older? You're looking at $300 a door or $350 a door.
Sure.
To do some of those. So, and that can eat into your cost basis. So you just really have to have replacement reserves. Repairs and maintenance is a big one. Management, of course. You also have vacancy. Utilities is huge. You got to have it. Insurance and property taxes. If you account for those 7 items and you are conservative and really give it a hard look at what is a realistic number and how that's going to increase over the next few years, you can be pretty safe that your NOI is going to line up with whatever that lender's NOI is going to be at.
I agree, and that's a good perspective, kind of from your perspective on you looking at different deals as a lender, right, and what that looks like. But you mentioned 2 things that I wanted to bring up still within this topic, right? Number one, insurance. It was interesting to hear, most of us out there are finally seeing a reprieve in insurance. So that actually does help a little bit from an underwriting perspective, right? You're not getting, you're getting, I mean, I heard some people say, yeah, we got 12% discount from last year, 20%, right? You might be getting a little bit of a discount then from what you were previously. So that's a positive, I would say. The other thing that you mentioned in there was third-party management, right? And obviously we at SITG, we do our own in-house management. And I think for a lot of the operators that, and I'm not saying don't use a third party, and we would use a third party in certain situations, right? But I think for a lot of operators that are looking at some of the more distressed deals, like we tend to do, right? Because there is more upside there. You really have to be the operator, because you have to go in and you have to be very hands-on. And we've done this, we've experienced this, right? We've gone in, we've taken properties that had, burn units, we've renovated them, right? You have to go through all those steps. You have to really hold on to it. You have to almost micromanage. I hate that word, but almost micromanage the situation and get yourself into a situation like we did with Excelsior, where it was 70% occupied, and then a few months ago we were able to refinance it because it was 94% occupied and cash flowing, right? So that's a key takeaway, I think, is those folks who are in that space that were using third-party management are now reconsidering that. I think it's a little different for Class A potentially, but there was one guy up there, I remember him talking about, hey, you think Class A is always the easiest or whatever. It's not. Sometimes it goes the other way, because there's TikTok videos telling you how to, basically commit fraud and not pay your rent, and those are all mostly in Class A. So there's interesting aspects to that, but
that was a great point. And just to kind of piggyback on that a little bit, that was an interesting fact that they mentioned that a majority, I shouldn't say a majority, because that could be a little bit misleading, but a good amount of fraud actually happens in the Class A. And also just when people are thinking of these new properties coming online, I mean, you're kind of topped out to an extent on that rent growth, because as so many different projects are coming online and being absorbed, there are a lot of projects that are doing concessions, and even a lot of the B and C class owners are worried about that, because
of course,
if you have a renter and you were thinking about potentially doing this rent increase because you're trying to keep up with your projections of what you're wanting to hit as your target, you are getting these new apartments that are providing anywhere from 5 to 6 weeks of concessions, and people will
they're
leave.
just trying to get beds and beds or whatever you want to call it, right?
No,
you're right.
2 months, or someone will leave for 2 months of rent.
They will, and I think it's more prevalent in certain markets, right? Probably Phoenix. I don't know the numbers that well. You probably know them a lot better than me, but I know in Dallas and in Austin, the amount of supply that's come to market has made it really tough to keep occupancy up in Class A in particular, right? Because you have 40-something thousand units that came online in Austin, a little more than that in Dallas. I mean, Dallas is able to absorb it because it's just a bigger MSA, but Houston didn't build as much, and so we're actually seeing we're okay there. It's not as bad as it is in say in Austin, for example.
Absolutely. No, that was some interesting. That was definitely probably my number one takeaway. That was considerably informative. Was like, hey, okay, everyone is pretty much in line with, hey,
we've all got
the heydays are over. We're here. You got to be conservative, because that's what's getting penciled. You can think, oh, I'm going to get X, Y, Z. It's just, you're not going to get across the table. It's just
you're not. You're not, because I mean, on your side of it, the lending side, a lender's not going to do it. Number one, right? So you're not going to get there on the debt. And then on the other side of it, when we're talking about investors, right? Investors, and I know a lot of people talked about this, expected certain returns that they had maybe gotten the years past, right? You want to kind of, tamp those expectations down a little bit, because we're probably not going to get those type of returns anymore. Can you still get fantastic returns, 12, 15+% returns in multifamily? Absolutely. And that's better than a lot of businesses. It's better than a lot of markets out there. And we talk about this all the time. The risk-adjusted return is better than if you go look at multifamily versus the stock market, right? So doesn't mean there's not going to be bad times, though. So we got to remember that.
And I mean, just to kind of go into our second option,
Yeah.
Or takeaway,
Yeah.
that is really right in line with what you were saying with how, you guys are taking, of course, on deals and making them more efficient
Right.
in terms of operations was the AI that they're utilizing for
that was
making
interesting.
the effective costs and being a little bit more effective in terms of how they're running it. That was pretty interesting of how AI is coming in and one of the topics that they brought up, and one of the vendors and companies that actually went up and spoke was mentioning how they want their leasing agent, and this makes a ton of sense. If you're at an apartment complex, you want your leasing agents to be friendly, welcoming. You want your tenants to be happy so that they stay.
Yeah.
But at the same time, these are the same agents that are having to call them right now, or in the traditional way, call them if they're delinquent, kind of making sure, hey, collecting and almost acting as a collection agency at the same time. And then when you see them in the morning or walking their dog, they're having to smile and say, hey, how you doing, Mrs. Jones, or whatever. So I can see where that could be challenging, as they mentioned, but now they have AI to where that will call them, 2-3 times a day, text, email, and it's almost giving leasing agents that kind of like, oh, sorry, that's them doing that, not me.
Yeah, and I mean, you know this. You can't expect them to be calling. I think what he said, and I remember this, that they call on the hour, every hour, right? Mm-hmm. And if it gets to whatever it is, 3-4 times, I don't even remember, then it calls their emergency contact that's listed as well, and lets them know, hey, this person hasn't paid, right? So that may seem very aggressive, and you don't want your leasing agents to be, I mean, me personally, I don't want them to be that aggressive from that perspective, right? Because you're right, they are a part of the community. And then number two, they're just probably not gonna have the time. They have other jobs that they're doing, within that. We all know operations is difficult. So you wanna make their life easier. So I agree, I thought that was a great one. Did you have any other AI takeaways that you remembered?
They did have other AI in terms of, some mentioned companies that, and they're still, obviously this is still growing. So I think that what we're gonna see in terms of this AI development within property management, being able to upload information about your HVAC system and your servicing, and it will remind you, hey, your HVAC is hitting this month, you maybe need to check it, or it's about time to start planning on replacing that roof. So that it's almost like a maintenance person always on it. And of course you have the service that they can provide in terms of if someone needs something and it's the middle of the night, they have a bot or an agent, if you will, an AI agent that can communicate with them. Yeah. So someone feels like they can always communicate with someone, maybe answer some of the smaller things.
That's nice.
And as we know, like if you're waiting for someone to answer and you need something immediately, some of these AI technologies can now start prioritizing. If someone's like, hey, water's out, or the heat's out, or the air conditioning's out, that's hitting the top of the list for your maintenance person. So when they come into the office, they know exactly what they need to do first and foremost, not, if it's something like a door is a little bit unhinged or something like that.
Yeah,
so,
that's a great one.
Interesting things coming, obviously, but that was a cool takeaway that I think, anyone's business can benefit from.
Oh, I agree. Yeah, I think we'll see more things that you're able to utilize, basically from an efficiency standpoint, right? How does it help you be more efficient in operations? How does it help you, just reduce time to do certain things, right? And those are great examples. I think, it's not, everyone's not going to use these, and you don't have to be successful, but it's good to have these options out there, and it's good to be looking for the new cutting edge technology to kind of help you, make your business more efficient, and anything you can do to really help your tenants, right? Be more responsive for your tenants. So I like it.
It's good.
Yeah, and our last takeaway was, now remind me, we wanted to talk about alternative sources of equity, because that came up quite a bit, and there was also some interesting takes on just the amount of money flowing into private credit and things like that, right? That are kind of filling the gaps that banks are not, or maybe they're just starting to get back into filling. on the debt side. So
Yeah, absolutely. That was very interesting, and I don't unfortunately remember the exact statistic.
yeah,
But one of the speakers was mentioning how they're expecting the private credit market, and this is for debt funds, private lenders, to hit almost 2.8 trillion in the next 1 to 2 years, which is incredible. It is giving, in my opinion, a lot of relief to banks, because we all know that this whole extend and pretend is real. Banks do have that. They, from whatever you think, banks are wanting to be your partner, and they do not want to take the property back. Not only is it a headache for them because they have to manage it, but also it is not good for the balance sheet and also the regulation. So if they can have private credit partners come in and buy notes from them, or even on some of these more distressed properties, not really, they're very conservative now. They're not really getting involved with them, or you're going to have to come with a ton of capital. Where the private credit market is stepping up. You're getting a lot of people that are, getting a little bit more hands-on with the property, walking the properties as investors, getting a higher loan to cost on some of these bridge deals. And obviously it's going through mostly the bridge market, CLO market that they're doing. But I think that's very, it's a great return for investors too. I think a lot of people, don't mind doing the lending side. It can pay well, and it does have a huge benefit. And I don't see that going away. I think that's just going to expand, just like they're expecting as well. Outside of that, I know that when we're talking about some of those alternative, I assume that it's just mostly an alternative to what we consider the traditional. Freddie Mac, Fannie Mae, HUD, banks, credit unions. I think private money, debt funds, those are alternative. And then one we're speaking about was CPACE.
Yeah, CPACE. Tell me a little bit more about that, because that's not something that I've really got into much. And my understanding is it's more on the construction side primarily, right?
Yeah, so you can use CPACE, and
explain real quick first what CPACE is, what it stands for.
Yeah. So CPACE, and actually that's a great question. It's an acronym. It's an acronym.
Oh man, I was hoping you knew.
It's an acronym. I need to actually research that. But essentially, what it is, it's a program that helps fund the construction piece for more energy efficient portions that you're looking for.
Right.
So you can use CPACE for renovations. Just regular, if you're not doing just construction, but if you're just doing rehab, it's a good option. But from what I found, and from what it seems like even of the panel, we had a CPACE lender that was up and talking about that, obviously at the alternative sources, was how it's very much used within construction, because it can be a very useful portion of your capital stack.
Yeah.
Now the thing is, it's only in 40 states right now. Unfortunately, in Arizona, it's not approved. So hopefully that changes. But in Texas, it is. Okay. So you can get CPACE in Texas, California, Nevada, and multiple other states as well. So that's something that, if you haven't heard of it, you can definitely look more into it. But essentially what it is, it will help fund things that are to be built to make a property more green. So this is like appliances.
Sure.
Your drywall, or some of your piping, or lighting is a huge one, and it has to save a certain amount for you to get this type of government CPACE of green efficiency. The good thing about it is the interest rate is usually pretty low. I think it's like in the 6s or 7s right now, and it's fixed. I believe it's fixed for like 30 years. So that's huge. And
where does that fit in the cap stack?
So it's a tax lien. So it's a lien on the property, but it is, I believe.
So you have your construction debt, right?
Yes.
And then the CPACE sits.
It can sit on top of that, but it is a lien on the property as so.
Sure,
So that is why a lot of banks per se aren't too comfortable with it as of yet.
Right.
Because at the same time, they don't want that to take over their seniority. Right?
Yeah, they don't want to fight for that.
But obviously, it can be subordinated. But at the same time, for debt funds, which is what was brought up for this alternative sources,
right?
They're okay with that, especially because it's transferable or assumable. And if it is fixed at 6-7%, in terms of a debt fund, that allows, and it can go up to 30%. You can do 30% of it on your capital stack.
Okay.
But I believe, and I'll have to double check on this, I believe it maxes out as a total loan to cost of 80. So what it allows is it allows your actual senior lender, or let's say the debt fund, to come in with less of their capital, and maybe that's a high interest rate capital, right?
Yeah,
maybe
it's probably going to be a higher interest rate than that. Yeah.
Exactly. Maybe they're coming in at 65, 70% loan to cost, and now you have the CPACE on top of that, covering an additional 10 or 20, and then now you're looking at a blended rate. So instead of you coming in with just a straight debt fund who's charging you 10% for the whole 75% loan to cost, you might only need, let's say, 60% from the debt fund, and then now you're getting a fixed rate from the some of the CPACE for some of those green products at maybe 6 or 7%. So that blended rate is going to be a lot lower for you, which can make more sense and make deals pencil out. So that was really interesting. Man, that can help not only save money and make a deal even more attractive, but maybe
I could see how they could help a lot of developers kind of bridge that gap, because it's difficult to develop right now, and we've seen that in the market. We've seen the market fall off from a development perspective, and it makes sense, right? Interest rates go up, whatever they went up, 500 basis points in a year, right? It's not every deal's gonna work anymore. And there wasn't, surprisingly, as much concern about tariffs as I thought that people were gonna talk about. Little mention of it here and there, but not as much concern, and maybe that's just because there's been deals trying to be worked out and stuff like that. But it was a little surprising to me that more people didn't talk about that. But outside of that, man, I think it was good networking event for us. Good to be able to just kind of get a pulse for what others are doing and how they're feeling about the market. And I felt good knowing that we've already been doing some of these things that people said that they kind of started doing recently, right? So I felt good about that from our operations perspective, and thought, okay, well maybe we were a little bit ahead of the curve on some of these things, and that's a good thing, and that's where we want to be. So we're excited about the future. We still think this is a great asset class to be in, particularly for part of your portfolio. Right? And there's a big need for housing, and that's not going away. We know that. So
absolutely. No, I completely agree. And I mean, I feel like every panel site was asked about tariffs, and not anyone was up in arms about it. It was kind of something that was just a second hand, but everyone seemed to be on that same level, which was good. Even about rates, people were like, hey, look, rates are probably going to be within 50 basis points of where they're at now. When it gets closer, maybe when the 10-year gets a little bit maybe below 4, then you start to really see activity pick up. And when it jumps up like to 4.5 like it has, it kind of puts the brakes. So we're probably going to ebb and flow around that for a while. And everyone was kind of like, this is a normal rate environment. So,
I agree. I think there's been some normalization now, and hopefully though there's more deals to be had. We still were hearing about distress and certain assets that lenders don't want to deal with anymore, and it kind of got our ears perked up on, hey, what deals are out there, right, for us. So we're back on offense now, trying to play offense and looking for what's next, and we'll go from there.
Cool.
Yeah. So, well, thanks, Fred. Appreciate you coming down for this and joining me on the podcast today. And
anytime. Thanks for having me.
Yeah, we'll look to do this again soon, my friend.
Sounds good.
All right.